Hello, everyone. My name is Micah. I am the marketer, community manager. I do a lot here at the ScoreMachine, also FICO Forge. And this is Ali. Ali, do you want to introduce yourself?
How you guys doing? I'm the co-founder of M2 FICO Forge and the Score Machine. How's everybody going? How's everybody going today?
Awesome. Yeah, I'm doing good. You doing good?
I'm I'm amazing. I'm amazing.
Perfect.
Happy to be here for another week.
I got some questions for you. Hope you got some answers. They're gonna help people with their finances, funding, and also their credit.
Hmm?
Yeah. You
Oh, there's gonna be a lot of good questions today. Hold
yeah,
on.
you ready?
I'm always ready, my friend.
Perfect. First question is why do some people get denied for a mortgage even after they feel they're doing everything right?
So, that's a great question, in the sense that people think that they have good credit. People think that their score is ready for a mortgage. People think that they're ready to rock and roll when they're actually not.
Mm.
So no shameless plugs today. This is all going to be about the Score Machine and M2 FICO Forge today. So we're going to be promoting our products today. We're going to be, talking about all that stuff today to make sure that you guys understand what's going on. So when we have a product that's out there, and we're going to use mortgage as the example, when you have a mortgage, you go to Credit Karma, you go to any of these places, they pull your credit. But when they pull your credit, they don't give you an analytical breakdown of what's truly on your credit. What they give you is basically you're either good or bad, and they give you a score. Now, yes, you can go view specific credit files or whatever it is that it's on there, but you have to do a lot of searching. Let's talk about the Score Machine. When you pull your credit report, and you can pull it from My Free Score Now and Smart Credit, when you pull it into the software is going to analytically break down everything on your credit report. It's going to look at your utilization on your cards. It's going to look at your installment loans. It's going to look at any previous mortgages that you have. It's going to break down your negatives, your inquiries. It's going to break down everything to see if you're fundable. Well, what's a perfect fundable file? A perfect fundable file in the Score Machine is a file that has everything that is green check marks down the board. So that means if you feel you're doing something right and you go into the Score Machine and you got more red than green, you're absolutely doing something wrong. So now in the Score Machine, for example, it tells you, do you have utilization under 30%? Well, if you go into the Score Machine and you look at your utilization and it says your utilization is in the debt breakdown is 48%, well, that's something that you're doing wrong. Now you have to adjust that. Go to the green check marks. If it's red under 30%, you know that it's bad. Say your credit score, we go based upon a 700 credit score. We want everybody to get the best rates possible. So let's break that down
Mhm.
even better again. So you go over there, you look, if you've got red, it means you didn't even crack 700 yet. So if you have green, it means you're over 700. So having that analytical breakdown on how it works inside the machine will give you the best opportunity to be able to figure out truly what is wrong with your file. It'll tell you if you have late payments. It'll tell you if you have a bankruptcy. It'll tell you if you have collections, charge-offs. It'll tell you if you have repossessions, liens, any of that stuff that's on your account. It will tell you what you have. By telling you what you have, then you can make a game plan on what you need to do to get that stuff ready or removed off of your credit report to then proceed to having the best chance at getting a mortgage.
Awesome. Love it. So, what are some hidden issues in a credit report that can silently kill mortgage approval?
Oh, debt utilization, late payments, charge offs, silent killers. Because if you have a charge off, it shows that you're not able to pay your bill. If you have a late payment, means you cannot every month pay your bill on time. And then your utilization. If you run amok on your credit with spending, they know you don't know how to keep your spending under control. So you need to make sure that all that stuff is handled under control. Everything is right. Again, utilizing the score machine is the best way to go about it to be able to get that price, not that price, excuse me, that utilization down. If you go to M2 FICO Forge, it'll help you get rid of your late payments. It'll help you get rid of your charge-offs, all that stuff. But that's already built into the system. If your system tells you, and the score machine tells you need credit repair, it brings you right to the credit repair software, so you can register for free, pay whatever it is when you need to get rocking and rolling, and start to attack your file properly.
Perfect. And how can someone with a 700 plus credit score not get approval for a home loan?
Very simple. File's not built correctly. How is a 700 credit? You can have an 800 credit score. You take 5 authorized users with 35 plus years age, you got an 800 credit score. Okay? It matters on the base of the file. So having proper trade lines. What I mean by proper trade lines, proper primaries. You should have a minimum 5 credit cards. It's the minimum that the bank requires for a perfect credit score. You see, so, well, I have a credit card, I don't use it. That's the whole point. You have one credit card that you don't use, and that's the reason that your score is not passing 680. The more that you have, retrospectively, the better off that you are, but there is a cap. You shouldn't have more than 15 before you are considered a file that is waiting to erupt or implode on itself because you have too much access to debt. So that's a big one.
It is a big one. What's the number one overlooked reason banks say no to first-time home buyers?
Their credit score, their DTI, debt to income ratio, DTR, excuse me. DTR. No, DTI, debt to income ratio. Man, yep. I was DTI, all that stuff. So let's break this down. You don't have the proper credit profile built. You're making enough money, but you don't have the proper credit report built. Say you have a 500 score, there's your reason you get turned down. Let's go the opposite way. It's not on the credit. Say you have a 700 credit score, you built everything properly, your utilization said everything, but then you go into when they start pulling your bank statements and everything and get you ready to rock and roll and proof for your mortgage based on your W-2s and everything. What happens? They find out that you're over leveraged. You're over leveraged with your credit cards, the way your spending habits are, and that's what causes you not to get approved for a mortgage. So you have to look at everything with a financial scope in saying, what is my goal? How do I achieve it? And here's the best thing that I could tell you to do for a mortgage. Stop eating out until you have your house. I mean, I got to take my own advice, but stop eating out before you have your house. Stop for a year, because that'll change your DTI immensely. And people tell you, oh, seriously? Yes, it changes it immensely. The average American spends $7,000 a year on eating out. That's $7,000 if you're making 50 grand, right? What is that $7,000? That's almost 20% of your file, of your earned income, just spent eating out. And what do I mean by eating out? DoorDash, going to the restaurants, Uber, all that stuff. Because they made it so easy to order that stuff. That's what it is. That's getting coffee in the morning. That's all that stuff. And again, like I said, I got to take my own advice. I'm not preaching to the choir over here. I got to take my own advice on some of this stuff. It's a lot easier said than done. It's because of convenience. Ordering on DoorDash and things like that is convenience. But when prepping for a mortgage, the best thing that you can do is start to financially analyze your file and make sure that if your credit is right, you need to make sure your spending is right.
Awesome. Why do mortgage lenders care more about what's under the surface than your credit score?
Let's break that down differently. Let's I love the question. The question's great. Because you've got to look at everything but the credit score. The credit score can be artificially inflated, like we were speaking before about authorized users. Let's talk about the credit score, how to build a proper file. And a proper file goes based upon trade lines, goes based upon installment loans, things like that. So when you put it into the score machine, right, and you see you have a 680 credit score, right, or let's go even lower, 620, right? You have a 620 credit score. You got one credit card. Well, that's the build process. How do you build your credit score to strength that you need? Well, I know that I'm going to go for a mortgage in like 2 years. So what do I need to start doing? Well, I need to get like 4 or 5 credit cards, start to build my score up, start paying them, utilizing them, getting them with limits and things like that, and start building that up. Okay. Now, same thing. If you're paying a car underneath, that's going to build up that next segment as well. That's going to build where you need to go to build a beautiful profile for the bank to look at and say, okay, this guy knows how to pay car loans. This guy knows, or the gal, okay, knows how to pay car loans. They know how to pay their credit cards on time. They know how to do everything. They have 2 years of history showing that they've done everything correctly. So at the end of the day, they're doing things that are proper, that need to be done. Does it make sense?
Yeah.
And that's where we need to break that file down to be able to see that. People don't understand. Oh, 620, I got a great score. No, you don't. No, you don't. 620 is not a great score. If it's under a 720, you have a crap score. I'm sorry. This is just the fact of the matter. This is the truth. This is the God's honest truth. If you have under a 720 credit score, you don't have a good score. You have a score that will get you by in life, but it's not a good score. Once you have over a 720, over a 750, they're going to start rolling out the red carpet. Once you get to 780, 800, they're literally going to gift you stuff for having that score because they know you can pay what you're talking about. I can make a payment for $15,000 on my credit card if I spend it. I could buy a $130,000 car and being able to pay it back. I can buy a $2 million house and be able to pay it back. That's the key to it. So understanding how to build that profile, that's the whole point.
Why are so many people with decent credit still paying 15 to 20% on car loans?
Well, it's the basis of the file. Think about the file. If they think that they have decent credit because they think they have decent credit, they go pull it in the score machine and they find out they have a 510 credit score, right? They think that's decent, right? Mm-hmm. Because it's 200 points higher than the base score, because the base score is 300, right?
Yeah.
If they think that they have decent credit, that doesn't mean that they have decent credit. So they need to know where they have bad credit. And if they have bad credit, right, what happens when you have bad credit? You get 15 to 25% loan because they know you cannot pay that bill. You're going to be a high risk. And that's why they're getting that. That's why they're getting those loan ratios, because they have to make the money as quickly as possible. Let's be real. I remember it was a Toyota Camry. It's an old It was an old thing that we used to do. Toyota Camry payment for somebody that had a 700 credit score is like $300 a month. This was back in the day, right? Yeah. With a 24% interest, right? It's like $600 a month. It was like $580, $560, something like that. It's almost $600 a month.
Yeah.
So almost twice the amount that you have to pay for the same car. That's not worth it. Mm-hmm. Just because you need a car? No. Pay a little bit extra, get your credit right, get what you need, get to that next level. Make sense?
Yeah. What's silently hurting your creditworthiness and making car loans more expensive?
Late payments, bad credit, low credit score, in this sense, charge-offs, repossessions. Banks will loan you because they want to make the interest, but that's hurting your credit worthiness to get you to the next level. So you need to make sure that is solved immediately. You need to make sure that that's, pristine.
Mm-hmm. Awesome. Why do lenders offer better car deals to someone with less income but better structure?
Because if you can pay the bill, that's the key. So yes, you may have less income. Let's use this as an example, right? You want to go buy the Toyota, right? You make $40,000 a year, but the guy that makes $60,000 a year makes more money than you. Here's your structure: 5 credit cards, okay? All positive payments, no collections, no charge-offs, no liens, no judgments, no repossessions, no mortgage, no short sales, no nothing. Your $40,000 is clean. Everything you make is paid. Your utilization's at 0, right? The guy that's got 60,000 that he's making, he's over leveraged. He's got 100% utilization, or 70% utilization. He's got 2 credit cards that are, one's 70 and the other one's like 26, right? You have, they've got a collection, they've got a late payment, they've got that stuff, and their credit score's a 512. While the person that's got makes 40,000 a year, it's got an 800 credit score. At the end of the day, means you know how to manage your money. And because you know how to manage your money, your credit score equals that.
Awesome. What makes auto lenders instantly flag your file even when they think it looks clean?
Instantly flag your file even when you think it looks clean. Ooh. What can that be? Utilization. Utilization. I think utilization is the biggest one. A red flag is somebody who's over leveraged. 90% utilization. Yeah, your files. Even with 90% utilization, you still have a 700 credit score. But 90% utilization means you're having a hard time paying your credit cards back.
Yeah.
So that's a big one. Yeah.
Awesome.
That's a good question. That's a really good question.
Yeah. Why does your auto loan interest rate have more to do with report signals than your score?
Because the score, like I said, is artificially inflated. So say you have an 800 score, you go in and they give you, I'm just going to throw out a number, a 13% interest rate. Yeah, you've got an 800 score, but that 13% interest rate is trying to tell you, hey, buddy, just to let you know, the credit that you did and everything that you did was horrible. So we're letting you know that we had to go to a high-risk lender. The high-risk lender is going to give you a 13% interest rate. I'm going to be honest with you. I had one when I was looking for my second car. I was about 22. My second car, I had bad credit. They gave me my interest rate on my second car was 18%. I was trying to go for a loan. 18% because I had bad credit. So what's the moral of that story? I did not buy that car. And I got my credit right.
Yeah. Awesome. We're going to move on to SBA loan specific questions. First one. Why are small business owners constantly getting denied even if their business is booming?
Credit score. No 730 credit score. Simple as that. ScoreMachine, pull your credit score, make sure it's at 730. We have a business section built out just for the business credit piece that will tell you right there that you need a 730 plus credit score. That's what they're looking at for SBA. Minimum is 720, but we sell you 730. You want a little bit of leeway.
Perfect. What hidden credit report details are scaring away SBA lenders?
Very, 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 very. First off, credit score. It's always going to be a very easy question, very good question. First off, it's always going to be credit score. Credit score is your biggest key, but also no tax returns, no proof of concept in your business, no growth, no nothing. They don't want to lend to a business that's stagnant or dying. They want to lend to a booming business. So there's a lot that goes into that question that a lot of people don't understand. But you're just to focus in on the credit report details. Usually, the person doesn't have a 730 credit score. How does that correlate? I'm gonna add my own question into here. How does that correlate? If your business is truly booming and making money, right? You have money to pay your bills. When you have money to pay your bills, you're not over leveraged, you're not overutilized, you're not over anything. So what happens is now that the SBA looks at you and says, okay, his money's right personally, which means his money is right in his business.
Mm-hmm.
That's the key.
Awesome. What personal credit mistakes are secretly tanking your business loan chances?
Not having that 720 credit score. Yeah, legitimately not having that 720, 730 credit score. It's any late payments, any charge off, any collections, any of that stuff. Oh, they're killing you. They're killing you. They're literally driving the ability to get capital down the toilet bowl, swirling right down. That's the key.
Awesome. Why is building business credit not enough to get approved for real capital?
Because you need bank return. You need bank statements. Not bank statements. Excuse me. You need tax returns. There we go. I said the right thing. You need tax returns to get back into the business to show that you're truly making money. That's why they tell you you have to let your business make money. You don't want to show that your business makes zero, because the truly way to utilize it is to say my business is making money and pay a little bit so you can get access to a lot of it.
Mm-hmm. Yeah. Awesome. What do lenders actually want to see before saying yes to a small business loan?
730 credit score, business making what you're looking for. So if you're looking for a $500,000 loan, you're making the ability to pay that. I usually say if you're looking for a $500,000 loan, you're making at least 30 a month. Okay, to be able to pay, because if I remember correctly, one of the terms is 10 years. They have all different terms, but I remember one of the terms that I looked at was 10 years. And that term of 10 years was like $3,000 a month. But if you're able to take that term, how much can you grow? Can you build a location? Can you put it into marketing? What can you do with it that will cause you to skyrocket?
Sweet. I got some more general questions.
Mm-hmm.
What's silently stopping people from getting approved across mortgages, cars, and loans?
Credit report. The actual nuts and bolts of the credit report. If you don't have a properly built credit file and everything is artificially inflated with authorized users and fake primary accounts, you're going to have a hard time, because when those primaries fall off and you have an issue, there's going to be a big issue. Make sense?
Yep. What's the invisible credit trap that makes you look fundable but still get denied?
Utilization. Utilization. That is the biggest trap in the game. If you're over 30% utilization, I think you could be at 31. It can cause your fundability to go down tremendously.
Right. Why does applying for the wrong loan set your entire credit journey back 6 months?
Damn, that's a good question. Holy crap. I had to think about this for a second. Why does applying for the wrong loan set your entire credit journey back 6 months? Well, let's talk on a personal level. Let's not talk about a business level or anything. Let's talk about a personal level. Applying for a wrong loan, whether it be the wrong mortgage or a wrong personal loan or a wrong car loan, set you back. It could set you back 2 years. Because first off, the inquiry. Okay, the inquiry that stays there is going to stay with you 2 years. That's a request for debt. But the same thing is the actual percentage that you're applying for. If your percentage is too high, right? And you apply for you apply for this loan, and the percentage is too high, that's going to set you back too, because it's going to take more money out of your pocket. So you really need to look at what you're doing with that and make sure that you're doing it correctly. Make sure that you're looking in the ScoreMachine, looking at your fundability, and make sure you're going in over there to make sure that you get the right APR, you get the right loans, and get everything that you need that's proper for you personally and your business.
Perfect. What are lenders really looking for? What are lenders really looking at when they decide if you're worth the risk?
The whole nuts and bolts, not the number. The number doesn't mean nothing. So your utilization, your amount of cards, your amount of revolving accounts, let's say that, not amount of cards, amount of revolving accounts, the installment loans, the mortgage, the overall breakdown on a FICO breakdown is literally what they're looking at. Your credit mixture, your request for debt or new credit, your payments, your actual utilization, because the utilization is huge. And I think I hit all of them. Yeah, I hit all of them.
Mm-hmm.
All that stuff together creates this pie graph, and that's what they look at to make sure that if you're fundable or not, and you won't be a huge risk. The more you have in that pie graph, the less of a risk you are.
Sweet. Last question. Why are so many people getting denied? Not because of their score, but because of something they've never been taught.
So they're being denied because not all knowledge is common knowledge. So you get everybody. A perfect example. You sign up at school, you see an event. I remember I was walking in a franchise event and a lady from Amex was following me around trying to get me to apply for American Express card. Well, I did. I didn't need the card. Retrospectively, knowing this now, I'm going to be honest with you. Retrospectively, knowing this now, I should have kept that card because the payment, the annual fee on that card was at the time $395 for a platinum card. But this is back in the day. But knowing what I know now, it changes everything. But truth be told, talking to you and talking with everything about this is we get pressured to open up a card. When we get pressured to open up a card, we don't know how our finances work yet. We're not taught how our finances are work. But here's the thing. We're going to learn real quick when we get into trouble. We learn how to go through all that. So the best thing that I say to you is lock in with somebody that understands credit. Talk to them, understand what's going on, understand how to build yourself up. I mean, we have a community right now, the Smart Hustles Club, that we teach we've got over 950 members that we teach people how to do this every single day. You know, we developed the ScoreMachine. We've developed M2 FICO Forge to help you guys get out of that rut because you've never been taught that. Come and learn from us and go from there.
Sweet. The last question. Thank you, everybody, for joining us. Ali, do you have any choice of words to end?
I do. When it comes to credit, I want everybody to focus. I want everybody to understand that a score doesn't mean as much as the profile. Understanding the profile is the key. Utilizing the tools that we've given you guys, we've given you the roadmap on how to get successful credit, how to get big credit. And here's the game. Get to the M2 FICO Forge for your credit repair. Get to the ScoreMachine.com to to utilize and view your credit. Once you're in those places, come to the Smart Hustlers Club. We're on school. Come to the Smart Hustlers Club. Get in with us. We'll put a link on wherever we're posting this, wherever you're seeing. We're gonna put all our links everywhere. Come lock in with us. We want to help you get to that level. Here's the thing. I don't make money on credit repair. I make money on funding. So getting you to a fundable file is the key. We want to get every single person to a fundable file and get them to achieve their dreams like we have achieved ours.
Perfect. That was awesome. Well, thank you, everybody, for coming, and we'll see you guys later.
Later.